to make it more simpler, to make it more easier for you. We have an expert with us, our regular, our very own Rajesh Jain, who's a financial expert, and you've been finding all his sessions very useful. So yet again, we have with us Rajesh today to help us through this process of IT returns filing. So he'll give us some very, very insightful tips to use and to follow as we are moving towards 31st December. So Rajesh, over to you. Please take it over and let's get started.
Good evening and welcome to you all. Thanks for taking out time for today's session. Before I start, let me just figure out if there are anyone who have already attended my earlier sessions. How many are new? If you are new, please type new in the chat window. And if you are like already attended, type already.
There are some more people to join in, Rajesh, and the biggest draw also is this topic. I will tell you, it resonates with a lot of people. I think this will be very, very interesting session today. And before Rajesh starts, I'll tell you that in between also you can use your chat box, and in the last 10 minutes we'll open for a discussion where you can unmute and ask as well. So Rajesh, please take it over.
Yeah. Thanks. I'm quite excited to actually see a lot of new guys today. Yeah. So let me just start a brief introduction about myself. You must be knowing who the hell he is because a lot of new guys. Just a minute. I forgot to switch off my mobile. I'm sorry, just missed out to put it on the silent. Yeah. So yeah. So this is Rajesh Jain, and academically my qualification is I'm a commerce graduate, Bachelor of Commerce. I have done my law from Nagarjuna University. I'm a fellow company secretary, and I have done my executive program in finance from IIM Kozhikode. In terms of my career, I started my career as an advocate in High Court. It was then Hyderabad, the High Court of Telangana, Andhra Pradesh. It was a joint Andhra Pradesh. In 2004, I started my career as an advocate. I was doing my CS and LLB parallelly. So I finished my law first, started my career as an advocate. Once I finished my CS, then I switched on my career from advocate to corporates. I worked as a company secretary and various other designations with listed companies like Surana Group, CK Birla Group. Then I did my executive program in finance from IIM Kozhikode and moved to finance field completely as a CFO in Horman Group. It's a German MNC. Finally, in 2018, I took the entrepreneurial route. I joined Weltree Group as a joint promoter and managing director. And since 2018, I have been associated with Ethica as trying to help them into various financial aspects. I'm personally a SEBI registered equity research analyst. I'm an AMFI registered mutual fund advisor, IRDA registered insurance planner, and personally have conducted a lot of training programs for MBA students, graduates, corporate employees in various aspects of personal financial planning, insurance, mutual funds, and also stock market. Stock market basically on fundamental analysis and investments. So this is who I am. I hope it satisfies you that you are at the right place today. Let me be very clear that, okay, I'm a financial expert, not a complete IT expert. Okay, IT is not my core domain. My core domain is financial planning and investment advisory. So try to justify the topic today. So what we'll be understanding is, normally what happens is most of us, even see, I have worked in a corporate, so most of us, we basically woke up only at the last due date, and then we try to see that what all things are there and try to collect the things. And we never try to, we always try to postpone that. Once the return is filed, there are certain corrective actions that we plan that I will be taking up next year, and then we again fail to take it up. So today, what we'll be starting is start from the basics. So let's start your understanding of payslip. So what are the various components that are there as part of your pay? what are the things that you can do, what are the various tax deductions that are available to you. Why this becomes very important again to understand is there is a choice that you guys have whether you opt for the old regime or opt for the new regime. So all for opting for the old regime, you need to understand the various tax reductions that you have. And if you want to go for the new regime, then no tax reductions, understanding or any inputs are required. But it is always better to understand to take an informed decision. So then we will see that, okay, what is the basic difference between the old and new tax regime that you have a choice now to opt for. What is the kind of ITR that you need to file, and how can you file your ITR online? So let's start with understanding your payslip. In between, if you have any doubts, anything, kindly feel free to put it in the chat window. I will try to address most of the doubts during the coverage itself, so that need not wait till the Q&A. If unless that question is interfering with the flow of the topic, what I would do is I will park this question and again we will take it up at the end during the Q&A session. So I hope this works fine for you. So are you all excited for this session now? To ready?
Yes.
Okay, thanks. Okay, so what I'm doing is I'm just putting you all into mute, not allowing you anyone to unmute yourself in between. So the only way that you can have an sharing is through the chat window till we reach out to the Q&A. Again, at Q&A session, we will be unmuting you all so that you can speak up. Yeah, Aditya, you will get the recorded link after the session today. All the sessions are available on YouTube channel of Ethica Work Life, and the same shall be shared with you. Yeah. So let's get into the components of payslip. Okay, so basically there are three components of the payslip. If you always see, the payslip is always divided into three components. The three segments are your basic salary, the allowances basket, and third is the deductions. So your basic salary is the top line. It always starts with your basic salary. Then there are a lot of allowances that are posted, like exempted allowance, like house rent allowance, your leave travel allowance. If you have academic allowance, all such allowances are there. And then there is again an allowance basket, which is normally taxable. So most of the corporates, what they do is they try to put in as many as exempted allowance. They break it up, and rest everything is thrown into an allowance basket. And then there would be a deduction component. The deduction component will show a deductions of the provident fund. If there's a provident fund deduction, then there's a professional tax deduction, and then the TDS that is being deducted as an income tax. So basically, when it comes to the major allowances as on date, the first and the foremost, the largest allowance component is your house rent allowance. So when it comes to house rent allowance, the house rent allowance is basically allowed as a deduction based on whichever is the least. That is the A, B, C. So A is your actual HRA. What is the actual HRA that is received? So say for example, if you have received your 2 lakhs is your 2,40,000, that is 20,000 per month as your HRA. So 2,40,000 is your actual HRA. 50% of your basic salary plus DA. DA is not shown in any of the private employees, but DA, that is a dearness allowance, is part of basically government employees. So for you, it would become 50% of your basic salary if you are living in metros, and 40% if you're living in non-metro. So if your basic salary is say about again 30,000, so it becomes 3,60,000. So 50% of your basic salary, that is 1,80,000. Then actual rent paid minus 10% of the basic salary. 10% of the basic salary again will become 36,000. So actual rent paid, so presume that you have paid an actual rent of about 3 lakhs. So 3 lakhs minus 36,000. So whichever is the less would be allowed as a deduction. In terms of HRA, kindly take note of that one thing. For HRA, if you are claiming an HRA of more than 1 lakh, you are supposed to submit the PAN number of your landlord. If it is more than 1 lakh, you are supposed to submit the PAN number of the landlord. You are supposed to submit the receipt from the landlord. Okay. Now, if you are claiming and if you are owning any house property, that you are having your own house, owning house property, but you are staying in a rented house, you can still claim HRA. So you can claim interest on your own property as well as claim HRA. Okay. Now, few people may be saying that, okay, we are living in with your parents. Are there anyone who is staying with their parents? Are there anyone in this group who is staying with their parents? Like neither in a rented house? Okay. Yeah, Vaibhav. So Vaibhav, yeah. So if you're staying with your parents, what you can do is you can still claim your HRA. How you can claim your HRA is, first thing is you can claim your HRA up to 1 lakh. So for up to 1 lakh, you need not quote any PAN number. So if you want to limit it to 1 lakh, you can just claim without. Second, you can start paying rent to your parents. So if your parents are not having any major taxable income, what you can do is you can enter into a rental agreement with your father or mother, whoever owns the property. Every month diligently, as you pay to your landlord, pay to your father, do a bank transfer. Officially do a proper bank transfer of the rent. Show this rent as an HRA, and the rental income should be again reflecting in your parents' income tax return as their income. Okay. Is this clear? So even if you are staying with your parents, you can still claim the benefit of your HRA. So if any one of you is not doing, at least from this year, because last year it's already passed on, at least from now onwards, you can start using this practice. But yes, remember, you need to ensure that you transfer it to the bank to your parent, and your parents show into their HRA. Else, you can claim your house as a rental up to 1 lakh without even reflecting into the PAN. Second is leave travel allowance. Now, leave travel allowance is a travel allowance which is claimable in a block of 4 years. That every 4 years, 2 times in these 4 years can be claimed as a exempted leave travel allowance. What is permitted under this leave travel allowance is your actual journey expenses. So, say for example, you have gone for a vacation with your family. So either you would have gone by air, you would have gone by train, or you would have gone by road. So whatever is a travel expenditure, not the stay expenditure, lodging, boarding expenditure, they are not claimable. Whatever the travel expenditure, if it is by train, your train tickets, if you're by air, then your air flight tickets, that can be claimed as an exemption. Now, for this purpose, entire family can be claimed. Now, family, who it is? Your spouse, your children, your dependent parents, brothers, and sisters. All these people form a family. So, normally, what happens is if there is any family function in your house, and if everyone is traveling together, try to preserve that tickets, try to preserve that family tickets, and you can use the tickets for claiming as a leave travel allowance. So, normally, there is a block of 4 years. Now, the current block of 4 years is from 2017 to 2021. So, if in the last 3 years, if you have never claimed leave travel allowance, you can claim leave travel allowance this year by submitting. If own vehicle is used for travel, then you will have to only submit your petrol bills. You will have to only submit your petrol bills. The rest, you need to arrange for some bills, which is not actually legally permittable. But yes, only travel expenses is allowed for the leave travel allowance. And then one more final deduction. Earlier, we used to get yes, we can claim only twice in 4 years. Out of 4 years, only 2 times. So if you don't claim as a leave travel allowance, it becomes your part of taxable salary. So out of any 4 years, only 2 years you can claim. Yeah. And then there's a standard deduction. Standard deduction is a flat deduction for all salaried employees up to a 50,000. So earlier, if you remember, there used to be a travel allowance, there used to be medical allowances. So just before the March, we used to run around, get some medical bills, medical shop bills, or some hospital bills and all, and we used to submit to HR. How many of you remember that? That was earlier permitted up to, I think, 15,000 or something was a limit. So 15,000 for that, and about 24,000 for the travel allowance. Then in the recent, about 2 years back, in the budget, they introduced it. Earlier it was 40,000, and current year it is 50,000. So up to 50,000 is a flat deduction. And it's a flat deduction. No documents are required to submit it. So this is the best part of it. So it can be straightway claimed. So please ensure that in your form 16, please check in your form 16 whether the standard deduction is reflecting. Standard deduction of 50,000 is reflecting or not. If it is not reflecting, please contact your HR and ask your HR to modify your form 16. Then what are the various deductions? So this thing is used for two things. First thing is, please check your form 16 whether all the deductions are reflecting or not. Also ensure that in the current year investment declarations, whether you have taken care of all these sections or not. So you'll be moving to the deductions. Now deductions, most of the people know about ATC. Okay, ATC is deduction where the deduction is available on savings, that is 1.5 lakhs. Now what all savings are coming under ATC? Any insurance premium that you make, your PF contribution. Already there's a PF contribution that is deducted in your salary. So whatever PF contribution you are making, that is deducted under PF, under ATC. If you are making equity linked savings scheme mutual funds, there are certain tax-free mutual funds which comes with a lock-in period of 3 years. For that, ULIP policy, whichever policy that is available. One of the major reduction which many people just ignore under ATC is your kids' tuition fee. So if you are making payment for your kids, so here what you can do is, if you and your spouse, if both are earning, what you should do is try to see that certain savings, like if you are paying any insurance premium or that is paid by one parent, and the tuition fees are paid by the other parent who is not doing any investment. Well, most of the cases what I have seen is father and mother both are earning, but the savings, most of the savings are there in the father's name. At the same time, the tuition fees is also paid from the father's account. So since it is paid from the father's account, the mother cannot claim this tax reduction. So please act diligently. So if both wife and husband both are doing, don't rush to go for this tax saving investment. What you can do is, one person can use this 1.5 lakhs by investing into tax saving. The other person can pay the tuition fees of the child. And if you have two or more than two childs, and like if the tuition fee is more than a lakh, like I've got two daughters, and both the daughters' tuition fee is 1.2 lakhs each. So what I do is, one daughter tuition fee is paid by from my account, another daughter tuition fee is paid from my wife's account, so that both of us can claim the deduction for it. I hope it is clear. Okay, so ATC. Now ATC, one more thing which many people miss out is your home loans. If you have taken a home loan, there are two components of a home loan. One thing is principal, second is interest. Now principal is allowed under ATC. For interest, there is another deduction which I'll be coming in some time. But the principal amount, that is your EMI, out of EMI, so you will be receiving your EMI statement, okay, at the annual statement. So out of EMI, let's say about 60% or 40% is paid towards the principal, 60% is paid towards interest. So both principal is claimable as reduction under ATC, and interest is claimable under deduction under separate section, which I will be taking care of in some time. Then at ATCC, there are certain pension products. ATCCD, Central Government Employee Pension Scheme. So this both you can ignore. It's primarily all put together as 1.5 lakhs. Now there is one more scheme, that is NPS. How many of you have not heard of NPS? National Pension Scheme. Is there anyone who has not heard of NPS? Okay, guys. Whether father alone can tuition fee? Yes, you can show the tuition fee of both the child, not an issue. What I'm saying is, if the tuition fee of both the child is more than 1.5 lakh, you can always split it between father and mother. But you can show both the child tuition fee into a single parent. That's not an issue. Okay. So NPS is like a national pension scheme. So this is a pension product which has been launched. Atal pension comes under 80cc. That is at your 80c. Yeah. The tuition fees is under 80cc. Yeah, Sushil. So what I'm speaking about is 80ccd now. So please focus on now 80ccd. 80ccd is an additional. So over and above this 1.5 lakh, which you can claim under 80c. 80ccd, you can claim 50,000. 50,000 is an additional benefit. So people who are under taxable bracket of 20% and 30%. Whoever is coming under taxable bracket of 20% or 30%, for them, this is one of the best investment because this is a national pension system. You can open an NPS account and start investing. This is managed by many of the banks like HDFC, ICICI, SBI. These are the banks who manage. You get an option of investing into different fund types, that is equity, corporate debt, and regular government treasury bonds. So you can distribute your investment into three based on your convenience. So if you are investing into NPS every year, what happens is there is a minimum investment. So 1 year, if you once open an NPS account, next year you need not invest 50,000. Next year, if you are not in a position to invest, the minimum investment that you need to make is only 1,000 rupees to keep your account active. So it is a discretionary investment. Like if you are investing into any insurance product or any other product, you may be required to pay regularly. But in NPS, it is a discretionary product where 1 year, if you have 50,000, you can invest 50,000. Another year, if you only have a 30,000 surplus, you can invest 30,000. But the minimum that you need to invest every year to keep your account active is 1,000. Okay. Now there is one more under ATC which I missed out is Sukanya Samruddhi account. Okay. So Sukanya Samruddhi account. No, NPS is for private employees. NPS is for I am a even I have an NPS account. Even I have an NPS account and I invest into NPS. So it is for any corporate employee. It need not be a private employee. And you guys, if you want to know the process of how to invest into an NPS and all, what you can do is you can contact me after the session. I will surely guide you on to how it can be invested. I don't want that to get dragged into this session purely about NPS. Yes, NPS, that is what I was coming about next. That NPS cannot be withdrawn up to 60, but it is for a pure pension. So why I am suggesting to invest into NPS is if you are investing, say if you are under 30% tax bracket, if you are investing 50,000, your effective investment is going to be only 35,000 because on 50,000 already 15,000 tax you are saving. So you are only investing 35,000, not big amount. Okay. So your return on this product is going to be very high because your initial investment itself is getting reduced by 15%. Like you're paying 50,000 and immediately you're getting 15,000 back. Okay. And this is a best way to secure for your retirement. And this is basically for people under tax bracket of 20 and 30%. People who under 10%, if your funds flows allow you, you can invest or you cannot. But anyone under 20 and 30, this really is quite beneficial. So please try to open an NPS account and invest into it. Now, other deductions that are available is ATD. Okay, ATD is for your medical insurance for your family and parents. Now, ATD, the total deduction, like for yourself, it can be 25,000. If you have a dependent parents and all, it can be up to another 50,000. So total deduction under this can be taken up to 1 lakh. So policy under your name, a policy for your dependent parents can be taken. If you're dependent parents, then the exemption will be much more higher. But this basically, I'm not saying that, okay, to save tax, you take a mediclaim policy. But if you have taken a mediclaim policy, please ensure that you claim that under ATD, both for yourself and your parents. Remember, if you want to claim for your parents, what you need to do is you need to what you need to do is you need to take the policy as you as a proposer. So you would be the proposer. So if you are taking for your parents, okay, so the proposer would be like Weber is taking for his parents. So proposer would be Weber, and the people insured under the policy will be Weber's parents. But if the proposer is Weber's father, then Weber cannot claim the premium that has been paid for that under ATD. So any investment that you are making at the time of planning that investment itself, you should see that how you can. So company provided mediclaim, can we claim for that? No. If company has paid for the mediclaim, obviously the company would be taking the tax benefit of it. That was Smita, you cannot claim. But anyway, one thing out of the context, though it is only for tax saving, out of the context, I always see, as I told you, I'm a personal financial coach. Always suggest people, though you have a company mediclaim policy, always suggest people to have a personal mediclaim policy as well. So always ensure that you also take a personal mediclaim policy. The reason is, if tomorrow you change an employment, your new company may cover, may not cover. Or even if they cover, they may only cover you, they may not cover your family. At that point of time, if you want to go for a fresh coverage, if you want to go for your own individual health policy, what will happen is there will be waiting periods. There is a waiting period of 1 year, 2 years, 4 years. So any pre-existing diseases, because nowadays there is a lot of lifestyle diseases like diabetes, BP has become very common. If any of these diseases are there, then there is a waiting period of 4 years. First thing. Second, if there is any gap in between, so for example, you resign from one company, another company you are joining after 1 month. So in or even a week. So even a gap of week can be costly. Within this week, if you fall sick, no, you are left completely uncovered. So one should always plan for a individual health policy, provided the finances permits. In fact, you should take it out. You should manage your finances in such manner. Then ATDTD is for maintenance and medical treatment of disabled dependents. So any of your, there are certain diseases that has been notified. Very few diseases come under this, like um, I just forgot the list. Yeah. So there are very few diseases that cover under that. So in that case, if for the medical treatment of your disabled dependent, this deduction can be claimed. So if you have any disabled dependent, like if he is completely physically unfit or something, then you can check out under ATD if the treatment is covered under that, and you can claim under that. Okay. And if any SSE is physically disabled for any reason whatsoever, even he can claim a special deduction under ATU. Then comes your loans. So under loans, there are two types of loans. One thing is education loan. Second thing is your housing loan. So education loan, if you have taken, then education loan, it is covered under ATE. The interest payable under the education loan is covered under ATE without any limit. So whatever is a actual interest can be claimed as a reduction. In case of house property, your home loan, maximum up to 2 lakhs can be claimed as a reduction. Now here again I repeat, one can claim both HRA as well as house property, provided the house property is rented out, or sorry, no, either rented out or is vacant, not an issue, but he's staying in a rented house and the house not in the own house property. What I've seen is many people, what they do is they take a house loan. Home equity loan, what you're talking about? I didn't understood, Aditya. So, no, mortgage loan, no. Mortgage loan, there is no deduction. It should be a home loan. Mortgage loan is different. Mortgage loan is where you have given home as your security. Your top-up loan, if it is added to your existing loan, it is shown as your house loan. It is shown as a home loan, it can be deducted. So it is all depend on the nature, the how the loan is shown. So if it is reflected as a house loan, no matter for what purpose, that is the reason if it is actually the top up is shown as a home improvement loan. So if you see it is home improvement loan, there is a capping of 30,000. So 30,000 interest on home improvement loan. Okay. So many people, what they do is they have a home loan to their residence. They stay in the same property and still they tend to claim HRA. So in that case, Cannot be done. But yes, if the house is in your spouse name, your house is paying the home loan, and if then you can enter into an agreement with your house spouse and you pay rent to your spouse. Demospita, whether it is under construction property or anything, once you have taken a house loan, you can claim the interest for it. The condition for claiming the house loan is that the house loan should be there in your name. It should be there in your name. So for claiming interest, you can claim. Yeah. Then in addition to this, there are certain donations which are allowable as deductions. So if you do, see, I see a lot of corporate employees nowadays making donations, online donations and all those stuff. But what we do is when we do the donation, we don't ask for receipt, or even if receipt has been received, you don't even make an effort to preserve that receipt. So most of the donations you donate to any of the NGO, most of the NGOs are either registered under ATG, ATGGA, or ATGGC. So in either case, there is a exemption available. Certain cases, 100%. Like if you have donated 10,000, 10,000 would be available. In certain cases, 50%, that is 5,000 would be available. In whatever the case, whatever may be the case, donations can be claimed, provided. So you should. So once you do a donation, once you make a donation, please insist for a receipt. Once you get a receipt, please look under the receipt. Under the receipt itself, it would be mentioned that eligible under deduction under ATG at for 100% or 50%, whatever would be the available. Then comes other deduction, that is ATGG. So ATGG is available for people who are not having any HRA. HRA, if your salary is not having HRA component, if your salary is not having any HRA component, no, there are no limits under ATGGC. But the political party, that donation that you are making should be registered under ATGGC. So ATGG is available for people who are paying rent, but there is no HRA. So if there is no HRA component, then up to 60,000 can be claimed as a rental under ATGG. ATTTA is a interest received in savings account. So interest received in your savings. So in your savings account, mandatorily there would be every 3 months there would be a credit of interest. Okay, most of us fail to disclose this credit, this interest, no matter how small it can be. It can be 30 rupees, 40 rupees, it can be even 1,000 rupees or 10,000 rupees. Irrespective of whatever is the amount, that amount should be disclosed as an income, and then you can claim as a deduction under ATTTA up to 10,000. So up to 10,000 on your savings account can be claimed as a deduction. And then ATTTB. ATTTB is for senior citizens, not for you. So it is not applicable for you. So when you become senior citizens, at that time that would be applicable. Okay. So now with this, we are coming to the difference between old and tax regime. Okay. So there are a lot of questions that have been posted. All these questions I will be taking up during the Q&A session. So please ensure to take up your question if that has not been addressed. The old and new tax regime, what is the major difference? Old and new tax regime, what is the major difference is? Under old regime, you have your income, then there are a lot of deductions So say I have an income of 10 lakhs. Under 10 lakhs, I have got a deductions about, I say 4 lakhs. Then my taxable becomes 6 lakhs. So the 6 lakhs, whatever is my slab, based on the slab, I pay up tax. So say for example, I have 10 lakhs income. I have got a deductions of 4 lakhs. That is as an HRA under ATC 1.5 lakhs, NPS, ATD, all put together, I have claimed 4 lakhs as my deductions. So 6 lakhs become my taxable salary. So on 6 lakhs, first 2.5 lakhs, this is existing tax rates. Okay, so I'm coming to the existing. So on the 6 lakhs, first 2.5 lakhs is exempt. So I will need to pay tax only on 3.5 lakhs. Balance 3.5 lakhs. Next 3 point out of 3.5 lakhs, first 2.5 lakhs, I'm going to pay only at the rate of 5%. That is how much? 12,500. And then on the next 50,000, that is over and above 5 lakhs, next 1 lakh, sorry, next 1 lakh, that is over and above 5 lakhs, I'm going to pay at the rate of 20%. So how much? That is 20,000. So 20,000 and 12,500, 32,500 would be my tax. Okay. So here you will be claiming various deductions, and after deductions, based on your taxable salary, you'll be paying based on the tax slab that is applicable, whether 20%, 30%. Okay. Now under the new regime, what it is there is a salary. You don't claim any deductions, neither your house rent allowance, nothing. No deductions are claimed. All the deductions you will have to forego, and you can straight away pay tax based on your slab. That is, if you are say 10 lakhs, first 2.5 lakhs is exempted, then you will be paying uh, on 2.5 lakhs, you will be paying at the rate of 5%. Next 2.5 lakhs, you will be paying at the rate of 10%, and the next 2.5 lakhs at the rate of 15%. Okay, so this is how you'll be paying. Now, what is the benefit? First thing is, let me give you a thumb mark. Okay, if you are a person who have already been existingly availing ATC deductions and ATT deductions, okay, you are paying 1.5 lakhs as an ATC deduction, you have got your tuition fees and all, you have got your mediclaim policies and all. If all these exemptions you are claiming, then somewhere around between 13 to 15 lakhs, okay, there is no much beneficial, okay. But if your income is over and above 15 lakhs, then you need to compare what is your taxability. In most of the cases, over and above 15 lakhs, the new tax regime is giving a better, lower tax incidence than the, but for people less than 15 lakhs and who are more prone for saving. If someone has started his job newly and don't want to block his money by investing into your equity linked saving schemes or into any insurance policy thing, they don't want to block their money there. They want a free flow income. For them, what they can do is they can avail the new tax regime. Okay. Now here there is a flip side. What is the flip side is, if you opt for the new tax and if you don't invest, okay, at the end of the day, you're not saving anything for your future. And if you are intend to save for your future, then mandatorily what will happen is you will either go for some insurance policies, you will go for some mutual fund investments. In this case, you will be better off going for the tax saving things and claim income tax. So basically, I would recommend that people who are under the tax regime of less than, like who have an income levels of less than 15 lakhs, please consider to opt for the existing tax rates by claiming as many deductions as possible. And people who are going for beyond 15 lakhs, please compare before you opt for the tax regime. Okay, but remember, once you opt for the new tax regime, you cannot go back to the old one. So you need to have a very conscious decision. If you want to take a decision, please always consult any of your financial planner or a tax consultant before you opt for this, because it's an irreversible decision. It's not that 1 year I go for the new tax regime and another year I will again go back to my old. Not possible. Now for the current financial year, one more thing was that for ATC. For ATC investments, people who have not done up to 31st March, there was an extension given because of the lockdown in the last 1 week. Because of the last 1 week, there was an extension given that any investment that has been made up to June can still be considered for previous financial year. So instead of March, if someone has done in April or May, any investments eligible for ATC, even that can be claimed for the previous financial year. but that needs to be specifically declared separately. Okay. I hope I'm clear. If there is any doubt with regard to old and new, please let me know now. Please post it to the chat window. Aditya, yes, in mutual funds, only ELSS funds have tax benefits. Other than ELSS, no other funds has tax benefits. Okay. Now, the major flaw that many of the people do is failing to declare certain income. So what are the kind of incomes that you should mandatorily disclose, no matter how small they may be? Is first is your bank interest, interest that you are receiving on your savings account, interest that you are receiving on your FD account, FD thing. Your bank interest should be disclosed and claim a deduction up to 10,000. Okay. Second, dividend received. If you have invested into any shares, and if you have received dividend, you need to declare your dividend received as other income. Okay. And dividend income is no more exempted. Dividend income is taxable. Earlier it was exempted, but now it is taxable. Third is capital gains on sale of shares or debentures. So if you have traded in any of the shares in stock market, if you have traded any shares, there may be a capital gain, there may be a loss, whether you are making profit or whether you are making losses. In either of the cases, you need to disclose your capital gain or loss. I missed out the slash loss, but whether it is a capital gain or loss, in either case, you need to disclose your transactions. Same thing, mutual funds. So if you have redeemed any mutual funds, on redemption of mutual funds also, there is a taxability. If you have redeemed any mutual funds, even the redemption also needs to be disclosed, whatever is the capital gain. So if you have redeemed any mutual funds, your mutual fund person will give you the taxability, that what is the capital gain that you have capital gain on your mutual fund that has been redeemed, and at that point of time you will have to disclose it. Income from house property. So if you are getting any income from your house property, even that also needs to be disclosed. Yeah. So what is taxability? When it comes to capital gain tax, what is taxability for capital gain taxes? No, Rohit, capital gain is altogether different. So your main income, salary income is different, your capital gain income is. So if you have loss in shares, you will have to disclose your capital loss, and then it will get carried forward. So in future year, if you make any capital gain, I think 8 years is the maximum allowed. Up to 8 years you can carry forward. In next 3-4 years, whenever you make any capital gain or profit in the shares, that will get set off, but it will not get knocked off under your regular income, regular salary income. It will not get knocked off. So capital gain up to 1 lakh is exempted. Beyond 1 lakh is taxable at the rate of 10%. Yes, Kadam, mutual fund cuts exit load if it is sold within 1 year. Okay. If you sell without after 1 year, there is no exit load in mutual fund. So if it is sold within 1 year, there is an exit load. At the same time, if you sell within 1 year, then the tax rate is going to be 15% and not 10%. But if you sell after 1 year, the tax rate is going to be 10% on your equity funds. And your debt funds, it is 3 years. So your debt funds you need to carry for 3 years. If you are not carrying for 3 years, then whatever the gain is there is taxed at a regular slab rate. But these things are disclosed only when you sell or redeem, not your book profit. Like you are holding some mutual fund units, you have not sold it, but as on date they are showing a profit of 1 lakh. You need not disclose it. You need to disclose only when you are redeeming it. So it's a capital gain will accrue only when it is redeemed. So whenever you are making a redemption, at that point of time only you need to disclose. Not every year when you are investing. I hope I'm clear on this. Yes. Then there is another mistake that most of the salaried class does is they presume that for a salary class it is ITR 1, that I need to file only ITR 1. No. For salaried people also, you may be required to file ITR 2 or ITR 3. Okay. So if you are dealing in shares, so these are the check your ITR, which one is applicable. So if you only have a salary, if you only have one house property, okay, and there are other sources of income like income from your bank interest, dividend income and all, then ITR 1. But in case you have two house properties in your name, okay, whether you are getting rent or not, but if you have two house properties in your name, first thing. Second, any capital gains, that is, you have traded in shares. If you have bought or sold shares, or if you have bought or sorry, if you have sold mutual funds, so any capital gains or any losses are there, then you need to file ITR 2. Many of the employees fail here. They just take their Form 16. Based on the Form 16, they file ITR 1 without disclosing any of the transactions that they have done into their trading and demat account. Okay. Earlier, many employees have done that was still undetectable because earlier it was not integrated the IT systems. But now, please take note that after Modi ji has come, he has integrated the entire tax network. Okay, so everything is integrated. Now, once everything is integrated, if you are not disclosing your capital gains or capital losses, there's a very high probability that you may end up getting a notice because it either now or later it is going to get tracked. So I would advise if you are trading into shares or if you have sold any mutual funds or please disclose it by filing ITR 2. Don't file ITR 1. So keep this in your mind. Then if you have started any business, because nowadays many people what they do is while even Divya ITR 2, I would suggest please go with some professional. If it is ITR 1, please do it on your own. But if it is ITR 2, ITR 2 is slightly complex. So please go with a professional. First time go with a professional. Once you are very comfortable with it, next time you can do it on your own. But no free tool is available. Most of the free tools are available for ITR 1 only. Okay. Now, ITR 3 is because nowadays what is happening is many people have gotten now, they have started their own businesses or anything. So if you have your own business, like if you have any partnership firm or any other firm, in that case, you will have to file ITR 3 and not ITR 2. ITR 4 will not be much applicable to you, you can ignore. So you need to see whether it is ITR 2 or ITR 3. So thumb rule, if you have any, if you only have your salary income and only one house property, then you are going to go for ITR 1. But if you have capital gains or capital losses that you have traded into shares, or if you have traded into shares, that means you will have either have capital gain or capital loss. Or if you have redeemed any mutual funds, in that case, you will have to file ITR 2. And if you have started any business where not your spouse, but you are the partner, and then you need to disclose that under by filing ITR 3. Now, where I can file the income tax return is Income Tax India e-filing.gov.in. Even if you are going with any other free tool, or if you are filing with your any income tax practitioner, please ensure that this is you get the online user ID password from your tax advisor. Many of our investors, whenever we like, say for example, someone is investing into any insurance policy or is making any this thing, we ask them for to send their IT returns for last 2 years or 3 years. What they do is, Rajesh, I don't have IT returns. I don't know. I need to get my user ID password from my uh, income tax advisor. So don't do that mistake. Please keep your login ID and password with you. We are at the end of the session. What I will do is I will just show you how this site works if any one of you has not gone to this site. And then we will conclude the session and we will go for the Q&A. Yeah. So this is the site. It is called Income Tax India e-filing.gov.in. So please remember all the government sites will have the domain name with gov.in. So please ensure observing that because there are a lot of fake sites with this kind of names, very parallel names. Okay. Uh, so if you are new to e-filing, I think most of you are returns are e-filed, so you are already a registered user. So if you don't have user ID password, please get your user ID password. The user ID is your PAN number. For some reason, the site is not responding. Yeah, so user ID would be your PAN number and password. Please. If you are not aware of, click forgot password, you will get it. Sorry. Yeah. So why I said is please use your thing is, see, this is a clear. What you need to do is before filing your income tax return, everyone should everyone everyone should actually go for viewing your form 26AS. So not just your form 16. There is something called form 26AS. So this is a tax credit statement that how much tax against your PAN number lies credit with the income tax department. So not only what form 16 your company has stated, you need to. So in your my account, you will get view form 26AS. Straight away, if you click it, it will take you to the site where you can see your form 26AS. Agree for it. View form 26AS. Okay. Select the assessment year. So your assessment year is 2020-21. For financial year 2019-20, the assessment year would be 2021. Okay. View as HTML. View or download. Okay. Here this is. So this is your. So this is my form 26 years. So here clearly from where, who has deducted the TAN of deducted, what is the amount that has been credited, what is the tax that is deducted, and what is the TDS that is deducted. Everything will clearly reflect here. Okay, so you need to look into all those deductions and ensure. So form 26 AS should be mandatorily downloaded. One thing. Second, you can directly e-file here. From here only you can directly e-file. E-file income tax returns. You go, you see assessment year is 2021, ITR form, select ITR 1, filing type, original. So there are two options. Either you can download the uh, Excel file, the utility file, and generate an XML file, or you can directly prepare and submit online. So if you are preparing and submitting online, okay, there are already account number that would reflect. You need to select account number for your refund credit. Okay, I don't know. Surprisingly, both my account number, like same account number, is reflecting price. So you need to select that, then continue. If someone wants Hindi form, they can opt for Hindi form. Okay. So when you are doing online, please check the pre-filled data before submitting the form. If you are doing online, please ensure that the return XML is prepared with the latest version of the utility. This is what the declaration comes. Okay. And then there are instructions. There's a general information that you need to fill. Okay. So I already have a pre-filled general information based on my previous return that I have filed. So it's a pre-filled form. Okay. So just check your this thing, the computation of income. Once you declare all your income, so this is pre-filled based on my form 16 that has been uploaded. Okay, so based on my form 16, if you see, it's a pre-filled. It's a pre-filled form. If you see where my total deductions, total income, everything is reflecting here. Tax payable on this thing, and including interest reduction, and everything is pre-filled here. Tax details, tax paid. So this can be easily navigated. If you have already know how to file and this thing, it can be easily navigated. Now, this is a schedule DI. This is an additional schedule only for this year. So people who are invested from, if you see, if you have done any investment from 1st April to 31st July, in that case, you need to have an additional investment declaration here. Okay. So exiting the form. Yeah, so with this, I think just a minute. Yeah. So how can I personally support is I can actually help you out in trying to do your own financial planning. I'm a financial planning expert. I can do your complete holistic financial planning. Akram, prepare and submit is there for all ideas. Whereas investments made from April to July can be either claimed this year or can be claimed previous year. So it all depends on you. So last year, if you have not claimed, if you have not made the investment, April to July, some investment you can claim in the previous year, some you can claim this year. So it is your option where you want to claim. So, and these are the glimpse of various training programs that I have conducted, me and my team that have conducted across various MBA colleges and all. I request you all to kindly join the Financial Hi-Fi Club. So this is a Financial Hi-Fi WhatsApp club. It's a WhatsApp group which is managed by, the link is there in your chat window. It is managed by Ethica Work Life, and I'm there. So I personally respond to any of the queries that has been posted in that group. So any personal finance related aspects, any queries can be posted into that group, and even all the recordings. Like every month we conduct a financial session. So whatever sessions are conducted, the recordings are posted into that group. Okay. So I request you all, if you find, if you have found this session useful, and if you would prefer to stay connected with me through Ethica Work Life, please join this Financial Hi-Fi Club. So this is my WhatsApp number. If you have any queries, in fact, you can join the WhatsApp group. That would be the best thing, because I prefer responding to most of the queries in the WhatsApp group, the Hi-Fi Club. Okay.
Thank you so much, Rajesh sir, for the wonderful session. Thank you everyone for joining the session. As Rajesh sir told that please join our WhatsApp group. If you have any doubts, you can reach out to Rajesh sir there. And please give us a feedback as well. We will do more and more sessions for you.
Now I've allowed you to, yeah, you can get the PPT. I'll be posting the PPT after the session in that WhatsApp group itself. So Daniel, if you need the PPT, please join the WhatsApp group, because we cannot individually share to anyone. What we'll be doing is we will be sharing that PPT in the group. So every session, after the session, and you mandatorily share the PPT. Okay. Yeah. So there were certain questions which I think I missed out, which I said we will be taking up in the Q&A. So if any one of you want the the questions to be repeated, please unmute yourself and repeat the question, or you can post into the chat window now, because there are a lot of messages. I cannot go back and read the old questions. Yeah, there was one question with regard to the home loan deduction on under construction property. Am I right? Is that person still there?
Yes, sir. We have Chakrabarti.
Yeah. So, yeah, Chakravarti, home loan for a under construction property cannot be claimed at the start of it. It has to be claimed separately. That is, say for example, if you have taken a home loan now in 2020, but the property you got handed over in 2022. Okay. So whatever interest that is paid from 2020 to 2022, these 2 years will get accumulated and will have to be added up as a separate thing in 5 equated installments. So you can claim, but again, this also would be up to maximum of 2 lakhs. PM Awas Yojana, sorry, Divya, I'm not aware of. You can just post this into the WhatsApp group. I would surely figure it out for you and revert back, because, sorry, PM Awas Yojana, I'm not an expert into. Yeah, I need to. Where can we claim driver salary, petrol bills, etc., which is salary component? And what if we have less petrol bills? Kadam, see, any travel allowances which your company is allowing is at actuals. So actuals means only when you submit any of the supporting documents, only then your company can consider that as a part of that allowance. Okay, so if you have a less petrol bills, anything cannot be done. Okay. So, and again, it all depends again on the salary structure of your company. So if your company is allowing as a travel allowance and are allowing you to submit the bills and all, then you can claim it through the company. But if your company is not allowing that, you cannot do. But yes, it can be claimed only to the extent of the supporting documents that have been submitted. This is a tricky question. As the broadband connection can be claimed or not. Actually, all these IT companies are now trying to have made a representation to the government. Okay, because as of now, there are no clear-cut deductions which are available. But I'm sure this budget, you will get the deduction even for your broadband connection. Okay, because till the pandemic, work from home was not a concept which we Indians ever encouraged or thought of. But I think work from home is going to be a new normal now. Like even my own colleagues, my own team, my research and broking team, are working from home since 15th March till date. Even though my office is open, my other team who are there into insurance and mutual fund divisions, they are coming to office. But my research and broking team are still working from home, which we even never thought of. In fact, we came to an extent that should we have such a large office now, or should we move to a smaller office? That is the concept. Okay, that's going to be new normal. I'm hopeful that in the new budget that is coming into the February, would be surely getting a new deductions for the broadband. Already, IT industry has made representation. Your ASCOM and NASCOM has already made a representation.
Hello, Rajesh. I have one question. Like as you said, if people are gaining any profit out of a stock selling, okay, suppose I have sold certain stock within this year, financial means the last financial year is already gone, and I have sold it right now. So do I would have to submit the ITR too, right, for that in the next year?
In the next year, not in the previous year. Because previous year there is no income, no, because there is no capital gain or loss. You have not sold any shares. You have just bought the shares and start on it.
Right. Right. So for the last year, for which the due date is coming on this year end, I have to fill the ITR one only. But for the
you have to
next
fill
year,
the ITR one.
yeah. For next year, I would have to show the details in ITR two, right?
Yes. Yes.
Okay. Okay. Thank you.
Kadam, up to 1 lakh, it is exempted. So any mutual fund, if you are selling and the capital gain is up to 1 lakh, it is exempted. Beyond 1 lakh only is taxable. And over and above 1 lakh, it is taxable at the rate of 10% if it is a long-term capital gain.
So it's similar in the stocks also. If it's not a
Same thing for
mutual
stocks.
funds.
Capital gain for mutual fund, equity mutual fund, and stocks is more one and the same. Only thing is you have to hold it for 1 year. If you are not holding for 1 year, then it will become a short-term capital gain. And short-term capital gain, there is no exemption. It is straight away 15%.
Okay, plain 15% deduction on the interest
15%
amount.
is your income tax on it. Not deduction, income tax of 15% on the capital gain. Short-term capital gain.
Okay.
So short-term capital gain, there is no. See, earlier, even why this 1 lakh? Okay, earlier up to 2018, no, your long-term, like any shares, if you are sold after a year, were completely exempted. There was no capital gain on it. There is no tax on the capital gain. There was capital gain, but no tax on long-term capital gain. Your LTCG, that is long-term capital gain, was introduced only 2 years back, and at that time they made a limit of 1 lakh. Now there is a lot of requests from the mutual fund industry and also various other industries to roll back this. Of course, the likelihood of that getting rolled back is very minimal.